A new report from TD says that as higher mortgage rates continue to slow home sales activity in this country, the average price of a home in Canada will fall 5% into the beginning of 2024. But that decline may not last for long. They also forecast that potential spring rate hikes by the Bank of Canada, resilient employment, and a lack of housing supply to keep up with demand could prompt a rebound in home prices in the latter half of next year. For more on this, we are joined by Rishi Sondhi, an economist with TD and an author of this report. Rishi, thanks so much for joining us today.
Thanks for having me, Jacqueline.
So you've highlighted how sales and prices are coming down, but not as sharply as they did at the beginning of the rate hiking cycle when we saw that first decline.
Yeah, so, back then, prices and sales were correcting from pretty highly elevated levels. So there was a lot of, I would say, for lack of a better term, froth that had sort of built up in 2021. Then you had the Bank of Canada hiking rates in 2022, and that took sales and prices down quite significantly. This time around, we've seen that rate hike, and there was an additional 50 basis points of tightening added into the system alongside, an increase in bond yields and the like. So I would say the scale of tightening hasn't been, at least from central banks, hasn't been as pronounced as it was back then. Also, the starting point is a little bit lower with respect to, actually a lot lower with respect to sales and even prices. So it's less sort of downside or less room to fall, I'd say, that sort of helps account for that. And, so that's a starting point argument that also relates to the supply-demand balance in the market. So earlier in the spring, we had this big run-up in activity, and that really tightened markets. So that tight market's heading into the Bank of Canada's latest sort of tightening decision or hike decision or set of decisions. So these tighter conditions at the onset sort of buffered prices to some extent, such that we haven't seen a huge drop across jurisdictions in the country.
Yeah, when it comes to the supply side of things and the listings that are coming to market, you were looking at the sales to new listings ratio and really highlighting the regional differences that you're seeing, Rishi.
Absolutely. It's really a tale of two markets when you look at sales listings ratio. BC and especially Ontario are well below long run averages in the sales listing ratio, which of course is a measure of the supply demand balance in a given market. Other markets across Canada are still pretty tight. From a supply demand perspective, that's less, I would say, weakness as indicated by that in some of these other markets. But again, honing in on BC and Ontario, that's really where you see that softness as measured or as reflected in this ratio, and that's where where one would expect the softness to show up, just given the extent of affordability deterioration that we've seen in these two jurisdictions over the course of the pandemic and even through the Bank of Canada's rate hiking campaign.
Okay, so let's take a look at your forecast then for the fourth quarter of this year and then into next year as well. We've got one of your graphs that highlights the sales and price increases or declines that you're expecting. Can you walk us through it? We're looking at it now.
Sure. Regionally, we're expecting, so, for example, at a national level, we're expecting sales and prices to fall, again, in the fourth quarter and the first quarter of this year. Sort of on a peak to trough basis, I would say from the third quarter, I should say, we're expecting sales to fall by about 10% across Canada and prices to drop by about 5%. Now, I will say that we did make these forecasts sort of in mid-September, and some data that we've had since then, most notably the uptrend in bond yields and interest rates has caused us to sort of assess that there could be some downside risk to this forecast. So I think that's an important point that I'll add on. But our baseline at the moment sees sales and prices falling through the first quarter of next year, and then starting to pick up as the second quarter sort of rolls around and the spring rolls around, and that's when we think the Bank of Canada will be cutting interest rates alongside falling bond yields, alongside robust population growth and a job market that bends but doesn't break. And all these factors should support demand and ultimately sort of underpin positive price growth. Now, we're not expecting overly robust price growth, I'd say, thereafter. And that's really a function of the fact that affordability is quite strained. So we think that affordability will restrain the pace of price increases that we see sort of in that second quarter and moving forward.
You know, I did think it was interesting, too, that you highlighted investor demand and that it was actually picking up into the beginning of this year, into the beginning of 2023. Do you have a sense of whether that has continued since then?
We unfortunately we don't have that Bank of Canada data available to us. It only goes to the first quarter of this year, so we can't say for certain. But we can say that condo sales have outpaced that of single detached units, and investors tend to typically buy condos over the detached space. So that hints that there's been some persistence in this demand.
Yeah, it is interesting. Did you find it a little bit surprising to see that pick up at the beginning of the year when you're thinking about perhaps some of these investors already being stretched by higher interest rates?
I wouldn't necessarily call it surprising, to be honest, at least in the early part of the year. I mean, real estate in Canada has offered an attractive return for a very, very long period of time. Interest rates weren't at these ultra high levels, necessarily at the beginning of the year. So it took some time for interest rates to sort of, hit these multi-year highs. So, there was some tailwind in that respect. Now the question, so we do have some idea that investor demand has been, robust potentially over the first half of the year. The question becomes what's going to happen moving forward in our view. And we do think that there's some potential for some steam to come out of investor demand moving forward, just because interest rates have gone up so much. Bond yields have gone up. So the rate of return on a risk-free asset is sort of comparable to the return that you get on an investment in a market like Toronto. So might be better off just parking your money in this sort of that risk-free asset space. So yeah, for these factors, or for these reasons, we think that investor demand could at least ease a little bit off of the sort of the multi-year highs with respect to its share and overall sales moving forward.